Understanding the concept of inducement can significantly reduce your losses, help you identify high-risk to reward opportunities, improve your trade precision, and lead to more consistent trading success. In this video, I'll walk you through everything essential about inducement, starting from what inducement really is, how to identify inducements in the market, and how you can trade without falling into the trap. So, if it is something you are interested in, kindly show your support by hitting the like button, also subscribe and turn on the notification bell to stay updated with our latest strategies and insights. Now, let's get started. First, what is inducement? Inducements are specific zones in the market where liquidity is intentionally created to tempt traders into taking false entries, often resulting in stop-loss hits before the actual market move takes place. If you don't understand how to identify and avoid inducement levels, you'll often find yourself entering trades from these zones, only to be stopped out right before the market moves in your intended direction, leaving you confused and frustrated. Let me give you a quick illustration. Imagine you've identified a break of structure in a demand zone, and you're waiting for price to return to the identified demand zone. But just as price begins to retrace toward that zone, you had another break of structure to the upside, with a new demand zone. Most times, this new zone acts as inducement, and many traders would assume it's a valid new structure and start entering buy positions from there, only for the price to give a small move in their favor, then reverse, hit their stop loss, and finally tap into the original zone and move in the expected direction. Now here's what inducement does. It appears like a valid zone, lures traders into taking entries from there, only to hit their stop losses and use them as liquidity to move in the actual direction. Now, let's look at what an inducement looks like on real chart. Here on the Euro-Dollar 15-minute chart, you can see we first had this break of structure to the upside, with our identified demand zone down here. So ideally, we should be waiting for price to return to our demand zone, so we can look for opportunities to buy. But instead of price returning directly to our demand zone, we had another break of structure to the upside, forming a new level down here, which looks like a new demand zone. Now, many traders might see this as a new point of interest and start entering buy positions from there. But in reality, this is an inducement zone created to lure traders into taking false entries, just to use them as the liquidity. Now, what price does is that it makes a brief pullback into the inducement zone and give a little reaction to the upside. At this point, those who entered at the inducement zone might think that their trades are now running in profit, only for price to reverse, hit their stop losses, then tap into the original demand zone and makes the actual move in the direction. So what happened here is that price used the liquidity from those stop losses to gain momentum for the real move to occur. Same thing applies to a bearish scenario. On this chart, we have this bearish break of structure here with our identified supply zone. So we should be waiting for price to return to our supply zone so we can look for selling opportunity. But instead of returning directly to our zone, price gave another break of structure to the downside, leaving behind another supply zone. Now, some retail traders will see this as a new point of interest and start entering sell positions from the zone. But in reality, this is an inducement zone, created to lure traders into taking false entries so they can be used as liquidity to fuel the main price move. Next, price pulls back, triggers their stop losses, then tap into the original supply zone and pushes down in the anticipated direction. So being able to identify inducement zones will help you to avoid being trapped, thereby minimizing your losses and increasing your chances of winning. Now the question is, how do we identify these inducement zones in the market? The truth is that there are different ways to figure out inducements in the market. But based on my experience in the market, one of the easiest and most effective way is by applying the concept of premium and discount zones, using the Fibonacci retracement tool. Let me give you an illustration. As we know, one of the core rules of trading is to buy low and sell high. Now, when big institutions want to buy, they place their orders at a discounted price. So they create this manipulation zone to tempt retail traders into taking trades from the premium zone, only for their stop losses to be swept, generating the liquidity they need to move price when their orders are filled. Now, if you find a setup like this whereby you have two demand zones, this is how to figure out the inducement. Just take your Fibonacci retracement tool and draw from the lowest point of the swing low to the highest point of the swing high. Now, any zone that falls within or above these three retracement levels are considered to be on a premium zone, and they often act as inducements, while the zones that form below them are considered to be on a discount level. These retracement levels are 0.5, 0.618, and 0.832. In this illustration, you can see that this upper zone happens to form at the premium level, so we consider it an inducement. In a bearish scenario where you have two supply zones, just pick your Fibonacci tool and plot from the highest point of the swing high to the lowest point of the swing low. Then check if any of the zones formed at a premium level. As you can see in this bearish illustration, the lower supply zone formed at a premium level, so we consider it an inducement. Now let's go over to the chart and see how we can implement this in a live market scenario. Using the example we gave earlier on the Euro-Dollar chart, we first identified a break of structure and a demand zone. Then, while we were waiting for price to come back to our demand zone, price gave us a new break of structure instead, leaving behind a new demand zone. Now, to figure out if the second zone is an inducement or a demand zone, we take the Fibonacci retracement tool, then draw from the swing low all the way to the swing high. Now, remember what I said earlier, that any zone that forms within or above these retracement levels are considered inducements. So, with what we have on the chart, you can see that the upper zone clearly formed within those levels, making it an inducement zone. In this case, the presence of this inducement zone makes the previously identified demand zone stronger. And that's where you should consider taking your buy trades, placing your stop loss just below the zone and your target at the swing high. And letting the trade run, you can see how price pulled back, clearing the inducement, tapped into the demand zone, and moved to our target. Same goes to bearish setups. In this example, we first had this break of structure and this supply zone. Then, while waiting for price to return to the supply zone, it gave another break of structure, leaving behind a new supply zone. Now we want to figure out if any of these is an inducement zone. So we just take our Fibonacci tool and draw from the swing high to the swing low. On a closer look, we can see the lower zone on the 618 retracement level, which confirms it as an inducement zone. So in this case, we will be looking to take our sell trades from the previously identified supply zone, setting our stop loss just above the zone and our target at the swing low. Now letting the trade run, you can see how price cleared the inducement, tapped into the supply zone, and moved in our direction. So this is simply how you can identify inducement zones to avoid being trapped, thereby reducing your losses and increasing your chances of winning. Thanks for watching. Don't forget to like this video and subscribe to our channel for more valuable insights. See you in the next video.